So if we take a recap and take a quick look at 2021, the S&P had a very good year. It notched 70 new all-time highs during the year. Volatility, pretty non-existent for the S&P during the course of the year. We went from an incredible amount of volatility in 2020, but in 2021, the S&P 500 barely reached a 5% correction, and you had it on two different occasions. And both of those occasions, they were short-lived, and the market bounced back very quickly. In the bond market, the Barclay Aggregate Total Bond Market Index, it's kind of like the S&P 500 of bonds. It did have a negative year in 2021. It was down slightly. Interest rates increased during the year, which works inversely to bond prices. So hence why we had the negative year with bonds. Inflation, it reached its highest level since 1982. That's certainly going to be a topic of our discussion today. The Fed went from saying that inflation is transitory to saying that inflation pressures may persist for much longer than anticipated. And when you look at the C-suite, you look at CEOs and those executives, the Conference Board survey a year ago, when you look at the results of that survey, inflation barely registered on CEOs' radar. It ranked number 22 on the list. It's rocketed now to number 2 here in 2022. And a lot of CEOs still expect more than half that inflation is going to linger into 2023 and beyond. Now, this last bullet point, NFTs, you had a non-fungible token of an ape of all things. It sold for $2.7 million. Doug, you can share the picture. I mean, you can't make heads or tails on which of these pictures is actually of the NFT that sold for that amount. But that really gives you a perspective of a lot of the excesses that we've had in the market. NFTs basically are it's a form of a token. It's a non-interchangeable unit of data. It's stored on the blockchain. It's a form of a digital ledger. It can come in the form of photos, videos, and audio. And because each token, it's uniquely identifiable, NFTs, they differ a little bit than the blockchain currencies such as Bitcoin. I think we're going to see more and more of these things with NFT occur over time. It's a form of an asset class that you can invest in. But again, it was some of the different levels of extremes that we were seeing in 2021 last year. So moving on from the volatility aspect of it, I mentioned that with the S&P 500, volatility was fairly non-existent. Now, this slide measures how many days it's taken over time before the market has experienced a 10% correction. And you can see here on the right side of this chart, we're coming up on 400 days since we last experienced a 10% correction. And there have been several times in history when it's taken 300 to 400 plus days before experiencing a 10% correction. So that expression we've continued to hear in the last year or so of buy the dip seems to have been the common expression for the stock market. But we would expect that volatility is likely to be more prevalent in 2022. And we wouldn't be surprised to see a 10% correction in the coming months.
And Casey, one thing to point out here, this chart referenced the S&P 500. If you saw a chart of the NASDAQ or the Russell 2000, which represents small caps, they have already undergone a 10% correction. And we'll look at kind of some of the details of that here in the next few slides.
Yeah, good point. We're going to take a little bit more of a deeper dive at when you look beyond just the surface of how the indices performed. You look at a little bit more of the makeup of it, and maybe the S&P was a little bit more benign, but some of those other indices certainly did have some more volatility. So this chart dates back to 1957, and it charts every market drop of 20% or more after the stock markets hit an all-time high. So that's what that ATH stands for on the chart. And on the bottom of the page are the number of calendar days after the market peak. So on the right side, the chart is 650 plus days, which is just under 2 years. And there are 10 market lines drawn on this chart. And 7 of these 10, they haven't recovered back above that 100 level, indicating that the market didn't recover the losses of that severe drop. And more often than not, it takes years for the market to fully recover losses. And that red line on top, that's charting the path of the drop in the stock market that occurred back in 2020. So I said hiccup earlier. It seems appropriate for 2020 when you're looking at the chart on your screen, because the recovery we experienced in that year that was induced again by the pandemic, it didn't follow the typical recovery script. We saw a drop, and as quickly as it dropped, in less than 200 days, you already saw a recovery of all those prices. It's certainly not your normal drop nor your normal rise. So we mentioned that 2021 was a good year in the market. So if we go on to the next slide, that the returns for some of the major indices on the left, you're going to see the S&P 500 index, it returned 23%. And the second column from the left shows, what was the largest decline of the indices during the year? And I mentioned before the S&P only dropped by about 5%, but what Doug was referencing, we're going to start to see here a bit more. You saw the NASDAQ and Russell 2000. So the Russell 2000, that's small company stocks. They dropped just over 10%. And that third column, which is the middle column there, indicates the percentage of stocks that had a positive return for the year. So the S&P had over 80% of the stocks in positive, which is pretty good. Maybe a bit more of a surprise, though. You look at the NASDAQ, Russell 2000, and they only saw around 60% of their stocks close with a positive year. Now, if we look at the fourth column, or the second from the right there, you're going to see when you look at all these cases that between 89 and 99% of all stocks at some point dropped by 10% or more during the year. Now, the real eye-opener, though, is this last column. The last column is, what was the average decline of each of the respective stocks within these indices? In the NASDAQ, the average stock declined 43% during the year. I mean, that's a huge drop. It's a very similar picture to the Russell 2000 as well. So, how do you have positive returns for the indices during this year when you have such large drops in these stocks? It's a good question. And what we're seeing is that many of the larger companies within these indices are stocks that perform better. The indices are constructed based on the size of the company. The larger the company, the larger the weighting in the index. So there are a couple thousand stocks, for example, in the NASDAQ composite. Apple's the number one company as far as size in that indice. It makes up more than 11% of the NASDAQ index. So it's good to be able to dig below the surface and see really what's happening within the actual stocks in these indices. And as we go to onto this next slide, you're going to see this a little bit more. And as you can see in recent months, many of these story stocks have stumbled. And a story stock is just referring to company shares who the values reflected expected outperformance. It's the combination maybe of some new innovation. It's been favorable press coverage. It's that type of company rather than its market value being solely based on fundamentals like assets, and you look at income components. And you've had a number of unprofitable stocks that performed well in 2020, and many of those are experiencing some severe level of pain here in the back half of 2021 heading into 2022. So, Doug, let's move on. Let's focus on the outlook of 2022.